Good evening, everyone. Welcome back to Sudden Wealth Syndrome. I'm here tonight to talk to you about the upcoming CPI release and also the Fed meetings. We are basically all eyes are on these two events this week, I believe. In my opinion, unless the CPI readings come completely out of expectations on the wrong side of it, I believe that the reaction of the markets should be fairly constrained. I mean, we should see some volatility throughout the day, but I wouldn't expect that major level of moves. However, we have seen a complete rally to the upside. Unfortunately, all the bears are getting destroyed at the moment, and this tends to happen when everybody is shouting for recession. Now, I know all the arguments, and actually, I agree with most of them. But the thing that is making me pause, making me think, is I open the Financial Times and it's recession talks everywhere. You open CNBC, you listen to CNBC, and it's recession. I mean, you go on YouTube to any of these finance channels, and it's the upcoming recession, worse than financial crisis, the next depression incoming at any minute. And my experience, and if you look at history, these are not how recessions actually come about. Now, I do understand all the arguments. I think some of them make more sense than the others. However, when everybody is expecting something, the market tends to do the exact opposite. So let's see what we've seen what have we seen this year? We have seen a low in 2022, and then we've seen the S&P trading, 39.50 to 40.50, and then between 40.50, 41.50, and then 41.50, 42.50, and it seems we are starting to approach the 43.50, 44.50. So it seems to be climbing a wall of worry. Now, in terms of rates, I do agree that it's either going to be 0 or 25 basis points. Personally, I don't think it makes any difference at this stage. The banks are actually tightening lending by themselves, so the Fed's impact in terms of rates is going to be minimal. I think it's only going to be somewhat of negative impact if we see rates rising more than expected. So if they will hike 50 basis points, I do not expect it. I think they will do exactly what the market already priced in them to do. And since we've seen such big rallies before the decisions, you may have some, buy the rumor, sell the news event. So let's say that you actually get the result that the market wants. There's a good probability you can see a sell-off right after it, as you typically see in this kind of events. Now, I'm not so much concerned about this short-term trading, about, will I catch this fade out? Is the market overbought? Are we going to drop 1% over a week? I mean, if you play that game, you're probably going to get destroyed. Now, I know that there's a huge appetite for this kind of content on YouTube, but there's a reason when you go to certain websites and it says 77%, 80% lose money trading with us. That's exactly what happens. So most of you, and me included, by the way, if I did the same, was going to get wrecked trying to predict the market movements such as this. I would look more at the global factors. I mean, what I'm struggling with the higher interest rates is not so much the short-term recession. Is it going to be a recession? Are we going to see Is the unemployment ticking 0.1% higher? Is mostly the biggest debtors in the world are governments, particularly the United States government. Now, is the government proposing budget surplus? No. Huge budget deficits. What about trade? Are we having trade surplus or trade deficits? Huge trade deficits. Now, what that means is every year they will need to borrow the money to pay for those two deficits. And at higher interest rates, the interest payments they need to pay on that accumulation every single year is rising, to the point where a huge percentage of the tax revenue is actually going for that. Now, how long can the US take those level of rates? I don't know. I mean, for sure, these things can last longer than you can stay solvent, so keep that in mind. I do think Q3 2024 has the potential for some fireworks, as a lot of the commercial real estate debt is maturing around that time, and some commercial real estate players are already struggling with the low interest rates, with the debt that they gathered during the low interest rate environment. So how are they going to finance themselves going forward? I have no idea. As it comes for banks, look, the Federal Reserve has mechanisms of raising rates while saving the banks, injecting liquidity in their banking system at the same time. And believe me, when it comes to important banks, they will save them. They are a central bank. They are put there by bankers, they are former bankers. Their mandate, unofficially, is to save the banking system. If that will create higher inflation, if that will destroy people's lives, that's completely irrelevant. That they don't care about it. So think about more in these terms of trends over the next 2 to 3 years, and try to avoid thinking, is this CPI reading tomorrow, gonna increase your portfolio by 1% or less 1%. I mean, that's really irrelevant in the biggest scheme of things. Now, when it comes to rates, a lot of people are hoping for a pause and eventually rate cuts. I actually think that's a mistake. A pause, I think, is very welcome, but the most bullish scenario would be for the Fed to hold rates as it is. If they keep raising rates, if inflation is getting too out of control, they will be negative for the entire market, of course. But if they are also cutting rates, that means something is deeply wrong in the economy, and basically they are failing. So holding the rates, showing that somehow the economy can take higher rates for longer, that will be more bullish than the rate cuts that everyone wants. In fact, just go back to the charts. Check exact moments when they cut rates. The immediate and it lasts some months reaction is the market goes down. And it takes quite some time to recover. Usually you need some fiscal stimulus in between. So I would be very careful for all those people that wish for rate cuts, because I'm not so sure that that's actually going to be a positive thing. Now, when it comes to inflation, the Fed and most central banks are targeting 2%. Now, if you look at the last 100, 150 years, and you'll check for years with inflation below 2%, I mean, they are maybe 10, 12, maybe 20 at the most. What I'm trying to say is that inflation below 2% is actually not very normal. That has been something of the past few years that we are just now taking into account as granted. Maybe we are going to enter a period of higher inflation. I mean, I'm not talking about 10, 12% inflation, but I'm talking maybe somewhere between 3 and 5 rather than 2. And it's going to be a matter of can markets and the economy adjust to that or not. I think the time for 2% inflation may be over. Difficult to say, we'll see. But I think, if you target maybe 3 to 4%, might not be ridiculous. Now, keep in mind that when I say 3 to 4%, I'm talking about the official inflation rate. All of us know that the numbers are fairly manipulated, particularly the shelter numbers, the homeowners equivalent, which is a complete mess and a complete lie. But I'm just referring to the official numbers that you see and the impact that they have in the market. There's no point in trying to predict how people would react to the real numbers. They react to the numbers they get, so that's how you should look at these things. Now, in terms of crypto, I think we are in a correction phase with all the SEC drama, let's call it that way. I'll make another video going into more detail on this one. I think we are still in the recovery year, so some selling, some disbelief, some hopelessness, and some nervousness is also normal. I know that it's not a good feeling. I get it, but relax. Crypto is here to stay, and it will stay here. And you shouldn't, again, focus in these next 2 months, 2 weeks, 3 weeks. You should look at December 2025. That should be your eye in the horizon. And for stocks, you should look, for the rest of your life, pretty much until you're 60. Then you can shift to bonds. But in any case, I'll make another video around it. So I just wanted to give you my perspective on the inflation numbers coming up, on what kind of repercussions they can have as well, the Fed meetings. Unless the market has rallied quite a lot, so you may be due for a pullback. However, if you get really extraordinary news, we can still push a bit higher, but I'll start to be a bit careful. We've risen pretty much on a vertical basis. Maybe relax, sit back, enjoy your days. In the next few days, try to enjoy your day. And if something gets hit that you like, not financial advice, but maybe consider accumulating a bit more. That's what I'm doing. And see you guys in the next one.